Thanks for taking the time to join us tonight. This evening, we have Ritesh, our Head of Investment Advisory from Syfe, and we'll be talking about some money moves to follow and the 6 principles of investing. Anytime during the webinar, please feel free to post us some questions in the Q&A column, and I'll be assisting Ritesh to answer these questions for you guys. Ritesh, shall we begin?
Absolutely. Thanks, Hayden, for the introduction. So welcome, everyone. Hope everyone is having a good evening. So today's session is about the 6 principles of investing and the money moves to follow. Now, this particular webinar is designed mainly for beginner investors who want to begin their investment journey on the right foot. But at the same time, this is also very relevant for more seasoned and experienced investors because in a way, it helps you think in a more disciplined manner in terms of how to go about your investing process. If you think about investments, usually it tends to become a little bit overwhelming if you have not yet started your investment journey because there is just an explosion of different investment options out there in the market. And what you don't want to do is basically just get swayed by rumors and particular things that are, top on mind in terms of more of the crowd following or herd mentality, but you want to bring a disciplined investment process such that long-term you can generate wealth for yourself. So this particular session is really geared to help you understand the 6 basic principles of investing. And if you follow those, you will be much, much better off in terms of having a smooth journey through your investments and having a great experience while you invest too. So without further ado, let's go into it, right? So the first principle of investing, it pays to invest today. Why do we see so? I mean, there's a famous saying, that within Syfe, we espouse a lot, that it is really time in the market rather than timing the market, which is important. And on top of that, it is really important for you to start investing now. I mean, if you keep waiting in terms of, oh, let me see if the market corrects or something happens and then I will invest, that whole aspect of waiting for the right time is most of the reason why most of us have money still lying in our bank accounts rather than invested. So just to give you an example and illustrate it in a manner that is easily understood, if you look at this particular graph, if you begin with $10,000 at a particular time, and if you just keep the money in your savings account, yes, you will have a good experience in terms of that $10,000 will remain 10,000, but over a longer period of time, it will hardly grow. Now, inflation, which is basically a measure of your purchasing power, that doesn't stop growing over time. It in fact grows at a much faster pace than money just sitting in the bank account or savings related products. What that means is if you just keep money within your bank account without being invested, the power of that money keeps reducing as we move forward. So a coffee that you want to purchase today versus the same coffee that will be available, say 1 year down the line or 2 years down the line, will be more expensive. So if you are not investing your money and not making your money work harder for you, it is very much possible or plausible that essentially will you be able to afford that same coffee going forward. Now, that is just like a crude example, but that just goes to show you that money just sitting idle is actually not the right thing. You should look to always invest your money. Now, investing does come with risks, but as I illustrated, through this example, not investing is an even bigger problem because when you invest, yes, if you look at the blue line, the money grows, but there could be periods where the money can take a big dip. Like if you see this graph in 2008, if you had invested into S&P 500, which is the US market index, initially the money is been growing, but there could be periods where the money swings and your wealth, deteriorates, and it can actually even go below the amount that you had invested before. So the idea is investing is meant for long term. It is meant for you to hold and ride it out. And if you have that mentality to ride it out, that's where you see the compounding effect of money. And that's where you see how your money grows over time and much, much better than what you would end up with if you had just kept your money in the bank. So I think very important to note that while investing is risky, not investing is even more riskier if you have a longer term horizon. So very important to note this as a starting point for this session. Now, let's also look at a quick example, right? I think this example basically illustrates the importance of starting early. Now, if you look at this example, there is Jill and Jack. Jill starts her investment journey at age 30 by investing $10,000 every year for 10 years. So she starts at age 30, stops at age 40. So she only invests $100,000 for 10 years. Now, similarly, Jack, on the other hand, doesn't invest at all between 30 to 40 and only starts investing at age 40. But in order to make up for the fact that he started a little bit later, he invests 10K per year, but instead of investing for 10 years, he invests for 20 years. So he's investing a total of 200,000 from age 40 till age 60. Now, if you assume that both of them get similar rate of returns at 8% per year, what would be interesting to note and understand is how does their money grow over time? And at age 70, who will end up with, higher amount of money, right? Typically, if you just look at it from a broad levels perspective, you would think that actually Jack will basically end up with more money because he's put in more money into investing, which is 200,000 versus Jill has only put $100,000 into the investments, right? But to your surprise, what you will realize here is that Jill actually ends up with much higher amount of wealth accumulation, even though she started with a much smaller sum. And this is really possible because of the fact that she started much earlier. She started at age 30, and she in fact only contributed till age 40, and she did not contribute at all through the years of 40 to 70. So the fact that she started off early enough is what makes her money compound over time, because this 8% per annum interest or return that she's getting right from age 30, 31, 32, 33. And that compounding effect is what, supersedes the fact that even though Jack has put more money into the market over the course of 20 years, but because number one, he started much later, and number two, it is spread for a very long time, at the age of 70, he ends up having, his wealth grow at a much lower pace. I mean, the rate of return is same, but the actual end dollar value that he ends up with, that's much lower. So Jill is actually having more than $373,000 by age, actually it is age 65, not even age 70, right? So by age 65, she's actually ending up at a much better place compared to Jack. So this is, I think, very important for all of us to note. And again, people who are on the fence in terms of thinking, should I begin now? Should I do it later? The right answer actually is, if you have not started investing, you should start investing today. If you ask me when was the right time to start investing, it was actually yesterday. So if you have not yet started, start now. Don't delay it by another 5 years, right? Or another 10 years, because this is what will happen, right? So very important as a base level principle number one, start investing and start investing now, right? Number two, don't put all your eggs in one basket. What does that mean? Let's look at an example again. Now, with respect to investments, there are obviously a lot of choices. And typically, when you want to grow your money and if you want very high returns, you need to put your money into investments that are super risky, right? Because there is no free lunch available, right? If you want more return, you have to take more risk. What that also means is, if you just invest into one asset class, say equities, because equity is supposed to be giving you the growth, it is possible that within equities and plus across asset classes, the returns might not be, top on the block for every year over year. So while this chart is a little bit, all over the place and a little bit, confusing, what you could concentrate on is the top level row. If you look at the top level row, it shows year by year which asset class had the highest return for that particular year. And what you will observe is no one asset class dominates the returns for year after year after year. So in some years there are, equity markets, some year it is real estate, some year it is fixed income, and some year it is international markets or small caps, right? So it's really, very difficult for you to time the market and to know that this particular asset class will give you, very good returns year over year over year. So rather than trying to, figure out what exactly to invest into and, which asset class will give you the highest return, because that keeps changing year over year. The right thing for you to do is diversify your risk and diversify your investments. So invest into a basket of investments that is across asset classes. And what that will ensure is, you might not end at the top, but you will also not end up at the bottom, and you will have at least an average return over the years. So this is very important for someone who is not yet started their investment journey and they want to get started. The right way to get started is to create a diversified portfolio, have that base level foundation built in, because the diversified portfolio ensures that you at least get average returns over time. And then once you have built your diversified portfolio across asset classes, that's when you can look at opportunities to further augment your returns on top of this, right? So very, very important to, not forget about diversifying your risk and investing across the board rather than just, lumping everything together into one asset class or one stock or one particular, segment or geography, right? All of those could have, binary outcomes, in the sense that, if you invested into international markets in 2018, you would end up at minus 15%, right? So not an ideal scenario, versus if you had invested into a diversified portfolio, you are in a much, much better spot, right? So again, reiterating, diversification is the only free lunch left. So utilize it to build a foundation to your investments. Number 3, manage risk versus returns. Why do we say so? The reason is simple. Once you have a drawdown on your, money, once you invest your, hard-earned money, and if the market comes down and if the market falls such that your investment value comes down as well, the road to recovery is a little bit harder and a little bit tougher. Why do we say that? Because if you lose, for example, you invested $100 into the market and the market falls 30%, your $100 will become $70. Now, if you want to go back from $70 to 100, you need 43% return to get back to that original level. Similarly, if you lose, say 50% of your returns, say your $100 becomes $50. If you want to get back to 100, you need 100% return. So it is very important to understand that risk management is very important. So you should have this at the back of your mind, that when you're investing, are you taking excessive risk? And by risk, we mean, are you, investing into speculative stuff? Are you investing into single stocks? Are you investing into single asset classes, which can have, returns that can dominate how your portfolio overall looks like? And what that can imply is that one particular investment can ruin your overall investment journey. And it is very important, again, to make sure that if you are loaded up into just one asset class or you are concentrated on certain names, try to diversify as much as possible, not just from an asset class standpoint, but also from a risk management standpoint, such that your drawdowns are reduced. Last year, for example, 2020, the S&P 500, which is the US stock market index, fell from, I think, if you had $100, it fell 35%. So you would have ended up at $65. And what that means is if you wanted to recover fully, you needed 50% returns. And typically, I think also why this thing is very important is because at the end of the day, we are all, as investors, risk averse in nature or loss averse in nature. Once you see a 20%, I mean, even a 10% loss in your portfolio, you start to have a little jitter in your mind. You are not able to sleep that peacefully. And if it goes to 20%, 30%, bear in mind, people who have invested before, it is really a tough time. And, you can panic and you can end up selling your investments. And that is actually the worst thing to do. Because if you invest and if you sell off your investments when the market is taking a dip, that's actually one of the worst, sort of outcomes that you can have, because you're capturing your losses, number one. And if the market recovers, you might be too late to sort of get back on and capture the upside. So very important to, alongside thinking about returns, also think about your downside risk and protect your downside risk as much as possible. Number 4, stay invested. So I think some of it I already covered in my previous slide, but this is, I think, what is very, very important, wherein this particular graph, if you look at it, it shows 2 pathways. The 2 pathways is basically talking about how your investment journey looks like if you invest for a fairly long period of time, which is like, from 2004 to 2020. So it's more than 16 years of investing journey for you. Now, within this investing journey, if you are someone who is trying to time the market, and again, if you are someone who is basically, if the market takes a sharp dip, you sort of try to come out of the market or sell off your positions with the view that, like, once the market stabilizes, I will come back in. The cost of missing the best days in the market in terms of recovery can cost you a lot in terms of returns over time. And this graph just illustrates this, that if you miss the 40 best days when the market moves back up from, the troughs of, going down, the returns that you can end up with can be significantly lower, right? Like, if you start with $10,000 and if you miss the 40 best days of uptrend in the market, you can actually, even after 15, 20 years, end up with less money than what you had previously, right? Versus in the case of you remaining invested for the full period, you can actually see your money multiply. So you're, ending up at $34,800, which is, say 3.5 times of what you started initially, right? So very, very important to stay invested. Time in the market is much, much important than timing the market. So, try to ignore the noise, try to not, be trigger happy. Let your investments, go through the ups and downs. In fact, if possible, you should top up your investments whenever the market takes a downturn, right? Also, I think it is very important, as we, most of us as investors, we have a regular income, we are professionals, we have regular savings. So if you have a more, steady passive investment strategy where you regularly contribute to your portfolios, that actually automatically makes sure that when the markets are down, you buy more units. When the markets are going up, you also enjoy the upside. And in a way, your average prices are much, much better than you just completely coming out of the market and trying to time your entry back into the market per se. And again, I think to sort of reiterate the point that time in the market is basically the crux of making sure that over time you have decent wealth accumulation and you don't have a bad investing experience. The reason for that is, if you look at this particular chart, it showcases you, if you have a 1-year investment horizon versus 5-year versus 10-year versus 20-year, how does your return look like? So broad level, if you try to see the red dots or the red bars in this graph, you will see that as your investment journey and your investment time horizon increases from 1 year to 5-year to 10-year to 20-year, the number of red bars start to come down significantly, to the extent that if you are having a 20-year time horizon, there has not been a single 20-year period where you have invested into the stock market and you have lost money, right? So it is always possible that, in a given year, the market just didn't do well and you can have a negative year in terms of returns. But if you extend your investment time horizon, you really give your portfolios and your investments the chance to recover. And if that's what is illustrated in, when you go to 5 years, the number of red bars are far lower. Once you go to 10 years, they're even lower. And, even the extent of how negative your returns are also much, much lower. And if you go to 20 years, as I said earlier, and this data goes back to, like 150 years back. So if you take a 20-year period, any 20-year period over the last 150 years, there has not been a single 20-year period where you have lost money if you invested into the stock market. So I think a very, very powerful message that, again, over time, if you remain invested, you will make money, and time in the market is, much, much important than timing the market. Now, I think on top of all of these other things that we discussed, it is actually very, very important to understand, what are the underlying investments that you're doing and what is the cost of those investments. So just to illustrate that, typically when you are investing, say, via, say, a bank advisory platform or, an investment advisory firm where an advisor charges you 2% to create a diversified portfolio, and if the underlying investments themselves are implemented using, say, funds and actively managed unit trusts, typically the cost that you pay on an annual basis ends up to be 2% or more. And this particular graph just shows to you how much of a difference that makes when you extend your time horizon of investments for 25 years. So if you're starting at $100,000 And if you invest for 25 years and assuming a 6% rate of return, over 25 years, if you're paying 2% fees on a yearly basis, for 25 years, what will happen is you will make at 6% $330,000. But because of this 2% fees, you're actually giving up almost half of your returns, right? Like more than half of your gains are taken away in form of costs if you're paying a 2% fee. Versus if you don't pay any fee, this whole profit that you've earned, it is basically for you to keep. So I think it is very important that alongside the fact that we mentioned that you should invest for the long term, you should start now, you should diversify your investments. It is also very, very important to identify investments and look at, what is the cost of your investment. I mean, I don't think there is any investment that comes without cost. So every investment does have some cost associated with it. But the idea is to reduce the cost as much as possible, or pay for products and pay for things that you actually really value, right? Like, if the platform or, the investment that you're doing actually gives you a superior return profile or gives you some value added services for which you are willing to pay that fees, and you have a much more smoother investment journey, that's actually justifiable. But again, maybe, I mean, now we are living in a world where things are very, very transparent. There are enough, ideas and investment opportunities available where you can reduce your investment cost to below 1%, below 1%. And, Syfe could be one of those platforms for you to check out as well. But paying a 2% fee on the current environment is just, enormous in my opinion. So just keep a lookout of, whenever someone is coming to you and saying, invest into this or invest into that, please take a close look in terms of what is the cost of those investments and is that cost justified. Lastly, I think very important to align your investments with your goals. Typically, when we start off investing, we just want to try it out, and because someone recommends us something, we say that, okay, let me put some money to work and see how it goes, and then I will top it up or add more money and grow my wealth. But ideally, what you should be doing is you should actually look at your current financial situation very, very closely. You should look at what are your short-term, medium-term, long-term goals, chart them out properly. And if you're a young investor, some of your goals could be buying a house, you want to get married, you want to save for your wedding expenses. If you are someone who is middle-aged, you might have dependents, so you might be thinking about children's education. You might have a mortgage, so you want to make sure that your sort of cash flows are evenly matched. You might want to retire at a certain age. So, all of these are key goals that you want to chart out very, very clearly. And each of these goals have a dollar value attached to them, right? So if you don't chart them out properly and you don't plan for your investments, that's where I think you can end up investing suboptimally. So if you have unclear goals and if you have, uncertainty with respect to your financial situation, that is what I think, that combination is what ends up in a situation where you don't know what to do. And, because you don't know, you will not do anything, right? Like, the action, the fact that you want to take some action, that whole aspect of, sort of why it is important to take that action is, it takes a back burner because you're not really clear why you should be investing. So once you define your goals clearly, there is a purpose attached to your investment, and you really want your money to work harder to achieve those goals that you have charted out for yourself. So again, I think things to reiterate would be that once you are starting your investment journey, try to look at your financial situation, see what your assets are, what your liabilities are, how much do you save on a monthly basis, do a budgeting exercise, chart out what your short-term, medium-term, long-term goals are, and try to also put some dollar values to them. Once you have put some dollar values to them, see how you can use your monthly savings and accumulated savings that are beyond your emergency funds. How can you invest those monies and your hard-earned wealth to make your money make your money work harder for you, and you being able to achieve those goals in a much more streamlined manner. Now, I think Before going into how Syfe can help, I'll quickly take a pause here. And Hayden, if there are any questions, happy to take those now.
Right. I think one of the questions that came in and we have covered a little bit earlier, for those that have joined us a bit later, of course, would be that, the difference between a dollar cost averaging strategy and a lump sum investments. What are the pros and cons, and ideally, what should one take in terms of the investment strategy?
Right. So that's a great question and something that we hear fairly often. I don't think it is one versus the other, that you need to either do dollar cost averaging or lump sum. Purely from a data standpoint, it has been shown that if you do a lump sum investment, typically 2 out of 3 times you will end up having more money over the course of your investment journey when you do lump sum investment rather than doing a DCA. And that's really because of the fact that usually it's an upward trending market. Like, the markets, the economies, everything grows over time. So if you're spreading your investment over a time horizon, you're basically buying at higher prices over time. So that can lead to a situation where if you would have invested all of your investments as a lump sum versus you spread out your investments with a DCA strategy, you can actually end up with a lower amount of return accumulation over time because of the DCA aspect rather than the lump sum. So this is 2 out of 3 times, but there is that aspect that 1 out of 3 times, there is also that case that DCA works better. And that's really the case where, there are significant downturns in the market and the markets are choppy and, there is no visible sort of trend in the market going up. So those are situations where a DCA strategy, tend to outperform lump sum. But broadly, the lump sum tends to outperform over a longer duration time. Now, in terms of people who are just trying to get started, I think everyone should have a combination of lump sum and DCA. The reason I say that is on day one, when you're looking to invest and you're looking at your balance sheet, what you will observe is that in your bank, you have already some accumulated savings because over, say, years of working or some other ways that you've accumulated wealth, you have certain savings that you have in your bank account. Now, of course, you should set aside your emergency funds, but after you've set aside your emergency funds, the surplus that you have, that is the money that you should look to invest in a lump sum manner. Now, if you're too afraid of the markets that, the markets are too high or, there are fears of a correction and stuff like that, maybe tranche out your investment, right? Like, tranche out this lump sum into, a 2 or 3 buckets. But I won't really say that, do a DCA strategy with your lump sum. This is the money that you should start investing now. The DCA should really be implemented with your monthly savings. So this is the second part of your financial planning where you should closely look at what is your monthly income, what is the monthly savings that you generate, and what are you really doing with your monthly savings? Because if you're already having sufficient emergency funds, these monthly savings are the monies that you should be investing on a regular basis. Because again, if this money goes back to your bank account, it's actually not doing anything and it is going to sit idle. So it is actually better to invest that into investments that you have already going and make that money work harder for you and use it also as a DCA strategy because that's the best way to implement a DCA strategy because it's sort of really matches your cash flow rather than you waiting for the right time to implement your DCA strategy per se. Right. So again, I think the right strategy is a combination. It is not one versus the other.
Right. Thank you, Ritesh. I think the other questions can be answered as we go through to the next portion. So we probably can come back to that later.
Sure, absolutely. So let's look at how can we at Syfe help you. So number one, I think before I go into the investment portfolios within Syfe, I'll give you a quick introduction about what is Syfe and our journey so far. So Syfe is a digital wealth manager. We are headquartered in Singapore. We launched our offering. We established ourselves in 2017 and we formally launched our offerings in 2019. Now it's been more than a couple of years since we've launched. We have a bunch of products on our platform. The real difference between Syfe and traditional sort of investment platforms is that we are a very purpose-driven investment platform and we are very goals-driven approach as well. And what that does is if someone is new to investing or someone who is an experienced investor as well, typically, when you invest via, say, a brokerage platform, it's a DIY strategy, right? You have to think about the markets all the time. You need to track the markets all the time. You need to then decide what investments to do, in what proportions you need to buy the underliers, and how to keep it optimized all the time. So there is a lot of work required when you are investing by yourself. Versus on the other extreme, there are the banks, there are the advisory firms, where, from the standpoint of they will work with you and construct portfolios for you. But what I have observed more closely is that the incentives are a little bit misaligned, where most of the bank advisors and all are incentivized to sell you those products where they make a lot of money. And because of that, it is not cheap when you go to these investment platforms to implement your investment strategies, because you will end up with paying 2-3% annual management fee. And as we showed earlier, these management fees can significantly eat into your returns over time. So this is these are the two aspects that we really wanted to address through the Syfe platform, where number one, we want to reduce your time commitment when it comes to investment, because you might not have enough time to watch the markets all the time and optimize your portfolio, at each and every market juncture per se. So what we have done is we have created curated portfolios that specifically look at different investment needs that you have. So whether it is for your retirement planning, whether it is for children's education, whether it is your savings bucket, whether it is your income bucket, or whether you want to just, grow your wealth, we have a solution for all of these problems that you might have. But at the same time, what we also want to do is we want to build a very scalable solution for you at, very cost-effective manner that you can invest into the market. And that's where, instead of, the usual 2-3% fees that you end up paying with the big banks or the advisory firms, when you invest with Syfe, you're paying a fraction of that cost, right? So let me quickly go over the investment portfolios first, in terms of, how can you utilize the Syfe platform to implement some of the, investing principles that we covered earlier. Now, typically when you have money, there are three aspects that you want to cover, or mainly three aspects that you want to cover when you are looking to invest your money. So those three aspects or three buckets are basically your savings bucket. So this is really money that you want to keep super liquid, super safe. This can be your emergency funds, where you want to keep it safe, but at the same time, you want to maximize your interest on it. Right now, given the very low interest rate environment around, most of the bank interest rates are very, very low when you put your money in the savings account. And what that means is, money sitting in the bank is actually right now almost like a crime. Having said that, it is not correct for me to say that if you are sort of moving money out of the bank, it does come with certain risks. So you need to take a certain element of risk if you want your money to work harder for you. Now, within our savings bucket, we have a cash plus offering. This particular offering is giving you a projected return of 1.75%. The way the cash plus portfolio is implemented is by investing into high quality money market and short duration bond funds. And because of these investments, because of the fact that these particular instruments give a certain yield, that's why you're getting this 1.75% return on it, right? Again, in comparison with a savings account, this is a much, much, higher return percentage. But at the same time, you're taking some element of risk because of the fact that you're, investing into instruments which can have some element of fluctuation over time. What we can say is this is a very, very low risk product because of the fact that it is investing into money market funds. The money market funds are usually instruments which are, super safe in nature. These are government bonds or treasury bonds, and they're maturing in very, short duration profile. And because of those aspects, the risk of you losing money is almost negligible in this kind of a portfolio, right? So I think the biggest risk that you have is potentially, underlier that we are investing into that defaults. The default risk is the biggest sort of risk in this kind of a portfolio. But because it is investing into government bonds or investment grade bonds, that risk is very, very minimal. And because of that fact, the 1.75% is a fairly attractive return considering the risk that you're taking. So that's the bucket number one, which is your savings bucket. So right now, I think this is one of the more popular portfolios on our platform as well, because compared to all the other offerings in the market, this is one of the highest rated returns that you can get for a fairly low risk product. Now, coming to more of investment opportunities and investment portfolios, when you're looking to invest, and the cash plus portfolio is great for just your money that you want to keep it liquid and you want to keep it relatively safe, but you want to earn some interest on it. But again, even the 1.75% over a long-term duration is not really going to help you beat inflation by a wide margin. So if you really want to make your money grow over time, you need to invest that. And to invest, again, if you're focused on growth, the real asset class that gives you growth is the equity market. So if you look at the extreme right, we have an equity 100 portfolio, which is 100% invested into the stock market. It is a high growth portfolio. It gives you, one of the highest returns on our platforms. Now, having said that it is a high return portfolio, it is also to be noted that it's also one of the higher risk portfolios on our platform, because when you're investing into the stock market, as I said earlier as well, last year, the S&P 500, which is the US stock market index, it dropped by 35%. So if you had $100, it went to 65. But of course, the market recovered significantly, and the year ended with the S&P ending at 18+% positive return for the whole year. So if you're someone who is having a fairly long investment horizon and you don't mind short-term fluctuations and you want to maximize your return, then an equity portfolio could be something that you can look at. If you're someone who is not that comfortable with a very high risk portfolio, you can look at our global portfolio, because the global portfolio is basically a mix of equity, bond, and gold. So while equity gives you the growth, the bond and gold portion of the portfolio really helps you to stabilize your investments and give you a smoother and steady journey through your investments time horizon as well. So again, depending on your investment time horizon, depending on your risk appetite, depending on what goal you're trying to solve for, you can invest into the equity 100 portfolio or the global portfolio, or you can even invest into a combination of these two portfolios to, number one, step, grow your money in a stable manner, but at the same time participate in the upside by investing into the equity 100. The third bucket that typically people look at is the income bucket. And the income bucket basically means that you want your money to give you a steady cash flow. This is typically, pretty, popular amongst our, older demographic clients who basically need a regular cash flow. They have a sufficient amount of wealth that they have accumulated over time, and they are looking at investments that can give them regular dividend yield or, regular cash flow. So REITs, by the nature of how they are structured, they are required to give out 90% of their income as dividends on a regular basis. And because of that fact, REITs give a fairly high dividend of 4.5% to 5%. So if you're looking at a more income heavy portfolio, this could be something that you can look at. On top of just the income, a lot of younger investors also like our REITs portfolio because of the fact that REITs over time also appreciate in value. REITs are listed like stocks on the stock market, and over time the REIT value increases as well. Plus, on our platform, I think what you can do is we have a mechanism where if you're a young investor and you don't really need income, you can use the dividends that you accumulate in your portfolio to be reinvested back to the portfolio. And then what happens is the whole portfolio grows as a growth portfolio rather than an income portfolio. So that choice is there for you, where if you want, you can use the REITs portfolio as a growth portfolio by reinvesting your dividends, but it can also be used as a purely passive income strategy for people who want to draw out that dividend on a regular basis, right? So again, broad level, if you're looking at savings, you look at cash plus. If you're looking at growth, you can look at equity and global ARI. If you're looking at income, then you can look at REITs portfolio. Now, I guess just going, pausing here a bit, Hayden, any questions about these portfolios that we have on our platform?
Right. So currently, one of the questions we have is that, is there a minimum amount to invest in any of these portfolios?
Right. So let me cover those in the next few slides. So essentially, number one, there is no minimum to start on our platform, and it is fairly easy to get onboarded. What you simply need to go do is, either download our app through the Apple App Store or the Google Play Store, or go to our website, www.syfe.com. there is a get started button. Once you click on get started, there will be a choice for you to choose one of these portfolios. So begin with one of the portfolios that you are most keen in terms of getting started. Once you choose that portfolio, it will ask you a bunch of questions. Based on the answers that you give, it will showcase you the portfolio that has been recommended for you. You can actually look at the portfolio details in terms of what are the underliers, what are the historical returns, what are the forecasts. Once you are comfortable with that, you will be able to create your account and get started. Post that, once you transfer funds to your account, you will be able to see the returns that accumulate and the value of your portfolio on an ongoing basis. Also, once your account is created, you are able to create multiple portfolios. So you can first maybe get started with REITs portfolio or equity portfolio. Later on, if you want to add a cash portfolio, it will be available on your dashboard to add, right? Now, in terms of pricing and in terms of minimums and other things, it is a simple, transparent platform. There are no hidden fees. The best part about starting off with a Syfe, with the Syfe platform, your journey of investments, is that you can start with any amount. There is no minimum. And the other great thing is there is no transaction fees. So typically for people who start off with smaller amounts, when you are trying to implement your strategies using brokerage platforms and all, you get hit with minimum brokerage costs and stuff like that. And that can really have a significant impact, because if you invest, say, $1,000 and you get hit with a $20 minimum brokerage cost, that's already like 2% that you're paying off in fees just to enter into the market. Versus in our case, we have an all-inclusive fee structure starting from 0.4%. All transactions are free of cost in the sense that there are no entry fee, there are no exit fee, there is no minimum balance. You can withdraw as much as possible. You can add as much as possible. So there will be no charges when you sort of add more money over time. And that's why, like, if you're implementing like a DCA strategy over time, contributing your monthly salaries to these investment portfolios, you can do that peacefully without having to worry about, oh, if I have to put, do I need to put a minimum amount, or do I need to put a certain amount to optimize, the cost of it, because there is no cost involved from a transaction standpoint. All the rebalancings that are done in our portfolios are done free of cost for you as well. Plus, all dividends are reinvested automatically. So the whole portfolio is optimized for you. The only thing that you need to think about is, the overall management fee that we charge. And this is sort of an all-inclusive fee because, we bear all the other charges that we are mentioning here, right? And if you look at this from the standpoint of what are the different tiers and how the fee comes down, the more you invest with us, right? So if you are someone who is just wanting to get started and wanting to try out our platform, you can start with any amount. The fees will be a little bit higher at 0.65%. But over time, as your investment grows with us, so suppose you cross $20,000 of investment with us, the management fee automatically drops to 0.5%. If your investments amounts grow beyond 100K, the management fee grows even below to 0.4%. On top of that, the cash portfolio actually has no management fee at all. So essentially, it is free product from our side. And it's really for everyone to get comfortable with our platform and then hopefully, grow their wealth using our investment portfolios, right? Also, I think very important to mention that, I look after the wealth expert team or the investment advisory team at Syfe as well. So if you're a black tier client or above, you get ongoing access to our wealth expert team, where any questions that you might have about our portfolios or, general markets, you can pose those questions to us as well, right? For blue clients is also available for the first month. So you can utilize us at least to get, started on the right foot. Now, quickly, I think comparing Syfe with DIY investments, some of these aspects I've already covered before. There is no minimum investments. You do not need to, create multiple, accounts for you to get started on our platform. You can simply onboard yourself using my info, and literally it takes like less than 5 minutes for you to get onboarded. Once you do that, essentially, as I covered earlier, all re-optimizations, risk management, dividend reinvestment, all these are done free of cost for you. There is no brokerage fee. The only thing that we charge is the management fee. You compare that with DIY, sort of products, you will have some minimums associated. There will be some requirements in terms of custody and brokerage accounts. Sometimes it takes, few days for you to get started. And then for DIY platforms, all these things you have to manage by yourself. And there is, multiple things associated with it in terms of cost. You will have to pay cost for all of these. On top of that, it is also the time commitment for you to spend to be able to achieve these in an efficient manner. On top of that, usually the brokerage costs are pretty high in Singapore. So, if you do 2 transactions, you're already paying 0.4, 0.5%. And if you're implementing your strategies using unit trusts, typically the unit trusts charge you more than 1.5% on an annual basis. So I think very, very important to understand the value that Syfe as a platform achieves for you, and the fact that you have a much more smoother investment journey, and the hassles of keeping track of the market and optimizing everything, all of that, sort of hard work is basically handled by us, right? And you're paying a fairly low fee for that work for you. As I said earlier, if you have questions, and we will take some more questions now as well. But if there are some questions that we have not been able to cover, please feel free to reach out to our wealth expert team. On the Syfe website, there is an advisory tab. Within the advisory tab, there is a way to schedule a free consultation call with our advisors. So please do spend some time on our website. If you have any questions, please go to the advisory page and schedule a time to reach out to us. Right? Before I go into the waiver, I will stop here for a bit to take more questions. But let me actually just cover it. I think let me just show this promo code as well. So people who have joined today with us, please note this QR code. If you scan it, basically there'll be a quick feedback form. After you fill up the feedback form, you will get a promo code. And if you use that promo code, basically you get 6 months of your investments managed for free for the first deposit that you do. So, and this is, I think, up to $30,000, I think, right? So up to $30,000, 6 months management fee will be waived off for your investments. All right, so I'll leave this QR code here, and hopefully we can take a few questions before wrapping it up. Aiden?
Right. So Ritesh, one of the questions we got is that, we have just shared our management fees, and, some users are curious in terms of what's the difference between our management fees as compared to ETFs out there, which seemingly do charge a lower expense ratio or fund management fee. So, what's the difference in this, and how come we are charging a little bit more than what ETFs are charging?
Oh, right. So I think it's important to clarify this 0.4, 0.5% or 0.65% is the Syfe management fee. On top of it, if you look at here, there are ETF management fees that are charged by the underlying fund managers. Now, again, because these ETFs, the prices themselves have these management fees already embedded within them. And if you look at all of our portfolios, we usually implement it using the lowest cost ETFs that are available in the market. So you're usually paying 0.1, 0.15% ETF management fee when you're investing via the Syfe platform into the different portfolios. And essentially, because of the lower management fee, the overall cost of investing is fairly low, right? So if you look at 0.4%, the ETF management fee, if you consider 0.1 or 0.15%, the total cost of your investment is roughly 0.5, 0.6% overall. And again, as I said, this 0.1% or 0.15% is actually embedded within the ETF management fee. So we don't charge this fee on our side at all. The only fee that you will see getting deducted on our side will be this fee, right? Because the ETFs already have the management fee embedded within their prices. Right? Now, the question to ask is this 0.4, 0.5, and 0.65% fee justifies, and does Syfe add enough value to your investments to sort of, be, considered for the fees that you're paying for us, right? And that's where I think we wanted to emphasize these points that, the fact that we are constructing your portfolio in an efficient manner, we are re-optimizing it, we are, reinvesting your dividends. So just this one point of dividend reinvestment for the REITs portfolio, for example, just this one factor that we are reinvesting your dividends adds 0.5% returns to your investments. So that by itself actually covers the cost of your investment on our platform. Versus, if you're doing DIY, then whenever there are dividends, you need to reinvest it by yourself. And there is a cost associated with those reinvestments. Plus, as I said earlier, there are no brokerage fee. Whenever you do DIY investments, each time you buy, you sell, you try to, sort of book profits or you take money out, there are fees associated with each one of those steps. There is no other fee. Those brokerage fees, those, hidden charges or any other fees are not applicable within the Syfe platform because we have bundled all of it together within the management fee that we charge, right? So essentially, the only fee that you need to worry about on the Syfe platform is the overall management fee. There are no transactions fee. There are no, re-optimization fee. There are no fees for dividend reinvestment. There is no minimum commitment. There is no withdrawal fee. There is no switching fee. You can switch between different portfolios at any point of time. There is no fee associated with that as well, right? So that's how I will, hope that sort of addresses that question, Aiden.
Right. Thank you, Ritesh. I think one more very popular questions we receive is that, with so much competition around, what kind of difference do we have and how do we stand out as compared to the competition in the market right now?
Right. I think that's a great question. I think, if you look at our platform, I think the number one differentiator is our products itself. As I covered earlier, we are a purpose-driven platform. We are a platform which is goals and objectives driven. What that means is we come up with very curated portfolios that really align to your long-term goals. So bunch of, yes, there is a fair bit of competition and actually pretty healthy to have that competition because it just goes to show that this is a segment and this is the kind of solutions that has been missing for our kind of clients. And, most of the traditional investment opportunities that you see around, they have far been, implemented in a manner such that they are too high fees and stuff like that. So what we have done is in terms of our portfolio offerings itself, we are very, very unique. If you look at the cash plus portfolio, we are the highest yielding cash plus kind of offering right now, or savings kind of an offering, savings alternative offering right now. If you look at the REITs offering, there is no other REIT portfolio in the market that does similar job as ours. This is also built in partnership with Singapore Stock Exchange because we are licensing their index, and it's a fairly popular index because we get you exposure to the top REITs in Singapore. So this is something that has been a widely popular portfolio on our platform. On top of that, if you look at the Equity 100 portfolio as well, we have a smart beta strategy around it. This is again a very differentiated product. A lot of platforms don't have a pure equity portfolio, and within a pure equity portfolio, they don't have aspects of the smart beta strategy implemented and all, where instead of just blindly constructing equity only portfolio by just combining 5 different ETFs, we have gone a step ahead and said that let's look at what are the factors that drive returns to your portfolio and how can we capture those factors in a systematic manner. And that's why if you would look at some of the underliers of our equity portfolio, those underliers are ETFs such as QQQ, which is supposed to be a growth-oriented ETF. And then there are other sector-wise ETFs as well that help to overall reduce the volatility of your portfolio per se. So these are very differentiated products. I think this is one uniqueness that you will find with respect to Syfe and that you will not find with a lot of other platforms. I think this is also really possible because of the kind of license that we have, that we can create these specialized strategies. A lot of other platforms just have an advisory license, which limits them in terms of the kind of strategies that they can implement. And they have to piggyback onto another platform to be able to, give you solutions. And because of that, they can only come up with very basic kind of portfolio offerings for you, right? So that's really one big reason why you can look at Syfe as a unique sort of portfolio offerings platform. On top of that, I said, as I covered earlier, I think the fact that you have access to human wealth experts and advisory team, that is something that you will not find with a lot of other platforms as well. I think when it comes to money and investments, it is fairly important to build an element of trust and confidence. So once you speak to our wealth expert, you will realize that we operate in a much more educational manner where we would help you understand what you're trying to achieve, if you're on track or not, and what are the right steps for you to sort of crystallize your investment strategy going forward, right? And if some Syfe portfolios could be relevant for you to solve for those goals per se. We are not going to be pushing products on you. We are not incentivized to sell products. There is no commission-based structure. So it is really educational in nature. And the idea is for us to provide a very holistic view of your investment journey with us, right? So these two are, I think, the key points that helps us differentiate versus a lot of other platforms. And on top of that, I think if you look at our fees, we are one of the lowest fee platforms to be able to do so as well. And given the way that we have implemented our solutions, we are very, very scalable in our approach as well. So the more you invest, the fee keeps coming down as well, right? So those are, I think, a few points that clients should note when they are looking at the Syfe platform in terms of differentiation and uniqueness.
Right. Thank you, Ritesh. And I think one important question came up as well, which is, how safe are their funds here if they put their investments with us here at Scythe, especially for the long term?
Right. I think that's a great question. I don't think we have a slide on it right now, but essentially what you need to note is that Syfe is a CMS license holder, and it has a fund management license from MAS. So this is something that you can actually look at on our website as well. So if you go to Syfe.com, what you will see right at the top is that we have this regulated by Monetary Authority of Singapore, and there is this license, and you can actually click on this license. It will take you to the MAS website, and it will tell you that what kind of license we hold, right? And this fund management license is actually a pretty powerful license because of this license, there are, safeguards put in place, which ensures that client assets are kept, safe and sound. As part of this license, Syfe is required to keep all client assets separate from our own balance sheet. And this is part of the requirement for this license, that we cannot commingle our own assets with client assets. And what that means is, if God forbid something happens to us as a company, your assets will still be safeguarded because they are held in custody with HSBC, Citibank. And again, our own balance sheet, our own corporate account, and everything is kept in a totally different bank account and a totally different setup altogether. So if something happens to us, our corporate accounts and our corporate balance sheet is affected, but the client assets are kept safe and sound because of the requirement that we need to segregate and keep it separate. And we cannot commingle our assets with the client assets, right? So God forbid, again, something happens to us, those assets will be safeguarded and we would be able to help you redeem them in full, right?
Right. So, Ritesh, maybe just one more question before we end off the session today.
Sure.
So, for users that have been funding their account in Singapore dollar, and some of our portfolios here are denominated in US dollar. So does this actually materially impact the portfolio in the long term in terms of profit or losses from a currency standpoint?
Right. So see, I think generally the currency does have an impact on your returns over time. But what we have found is, over a longer duration, if you're really looking to grow your money, you need to have a wider view of the market. Because if you look at the Singapore market is pretty narrow in terms of the investment opportunity set, especially if you look at the equity markets in Singapore. If you invested your money into the Singapore Stock Exchange going back 10 years versus what the value of those investments will be in Singapore dollar terms now, the money would have hardly grown over the last 10 years. Versus if you invested your money into the global equity markets, so you would have to convert your Sing dollar to USD or other currencies to be able to invest outside of Singapore and get exposure to the global equity markets. So even if you invested, in USD terms, say 10 years back, and let your money grow over time, what you will realize is that even though USD, say, depreciated against Sing dollar over the last 10 years, the fact is that the equity market returns from a global standpoint far outweighed the sort of negative aspect of currency that you might have observed. So for example, the S&P, I think, grew over 300% over the last 10 to 15 years, versus the sort of STI index has hardly moved. So if you're looking at it from a return standpoint, I think some of this we covered in our earlier slide as well. If you had invested, say, $1,000 or $10,000 in, say, 2004, right now the value will be $34,000, right? So even if the currency took a hit and depreciated over time, the fact that your money grew at such a substantial pace, that currency impact sort of diminishes over time. So in the short run, you might see some currency impact, and that might be a little bit alarming to you. But what you will realize is over time, the kind of returns that you will get with the global market far outweighs the currency risk element of those investments.
All right.
Does that help, Hayden? I mean, and again, there are some Sing dollar investments on our platform as well. So if you're looking at a more currency neutral approach, or a approach where you want to invest in more SGD terms, there is our REITs portfolio for you to look at. And that portfolio, per se doesn't have a currency risk because it is investing in only those REITs that are listed on the Singapore Stock Exchange and are denominated in SGD, right? So my view is that overall, we all should have a diversified global portfolio. But if you want to hedge out a portion of your currency risk, that can be done either via our REITs portfolio or some, money into our cash plus portfolio as well, if you want to keep it like super safe.
Right. Thanks, Ritesh. I think that's by and large the questions that we have this evening. We have answered most of them. Thank you, Ritesh. So,
all right, great. Thank you everyone for joining us today. Hope the session was useful. I think we will also upload this session onto YouTube and other platforms later on. So if you want to revisit some sections of it, please feel free to do so. On top of it, as I said earlier, if you have some questions that we were not able to address today, please do reach out to our advisory team. Thank you, everyone.
Thank you.
Bye.